What if I told you that $25 a week could eventually become the foundation of a portfolio that pays you every month? Right now, $25 probably doesn't feel like financial freedom. It might barely cover dinner, coffee, or a few impulse purchases. But here's the interesting part. You don't need a huge amount of money to start building something huge. You need consistency. And we're not talking about getting rich next year. We're talking about giving small amounts of money decades to work. So let's see what actually happens when Finn invests just $25 every week, reinvests the dividends, and gradually increases his contributions. First, let's make the number painfully simple. $25 every week means roughly $100 every month over an entire year. That's about $1,300 invested, not millions, not even tens of thousands, just $1,300, and that's exactly why most people underestimate it. They look at 1 week instead of looking at hundreds of weeks stacked together. After 5 years, assuming you never increased that $25 contribution, you'd have put in about $6,500. After 10 years, your own contributions would be around $13,000, still meaningful, but the really interesting part hasn't happened yet, because invested money can potentially earn returns, and those returns can themselves earn returns. That's where compounding enters the story. For illustration, imagine a hypothetical 7% average annual return. This is not guaranteed, and real markets will never move in a perfectly straight line. At that kind of hypothetical return, your portfolio could eventually become substantially larger than the money you personally deposited. Now add dividends. Dividends are cash distributions that some companies and funds pay to shareholders from their earnings. Imagine Finn owns investments that collectively generate a 3% dividend yield. Again, that's simply a hypothetical example, not a promise. If that portfolio were worth $10,000, 3% would equal roughly $300 in annual dividends before taxes. That's not enough to live on. But something important has happened. Your money has started producing money without another hour of labor. And instead of spending those dividends, Finn can choose to reinvest them. This is where our tiny snowball starts rolling downhill. The dividend buys more shares. Those additional shares can potentially generate additional dividends. Those dividends can buy even more shares. It's a financial snowball. At first, the snowball is almost laughably small. But with enough time, small additions can become increasingly powerful. Notice something important though. The magic isn't a secret stock, a perfect entry point, or a ridiculously high dividend yield. The real engine is boring. Consistently investing, reinvesting, staying invested, and giving the process enough time to work. And there's another accelerator that's easy to overlook, increasing your contribution as your income increases. Because $25 a week doesn't have to remain $25 forever. Your starting contribution is a starting point, not a life sentence. Let's compare 3 possible paths. They're hypothetical, but they demonstrate why increasing your investment rate can dramatically change the destination. Path 1 is simple. Invest $25 every week forever. It's slow, but consistency means you keep adding new money, regardless of what markets are doing. Path 2 starts at $25, but every year Finn increases his weekly contribution by $5. That might sound small, but over many years, those increases mean dramatically more money entering the compounding machine. Path 3 is even more realistic. Finn starts with $25, then increases his investment substantially when his career and income improve. Maybe $25 is all you can afford today. That's okay. The goal isn't to predict your future income. It's to build the habit today. Now let's answer the question everyone eventually asks. How large would the portfolio need to be to generate meaningful dividend income? The basic calculation is straightforward. Annual dividend income equals portfolio value multiplied by the dividend yield. Using our hypothetical 3% yield, $10,000 would produce about $300 per year before taxes. At $50,000, 3% would be $1,500 per year. That's still supplemental income, not financial independence. At $100,000, the same hypothetical yield produces $3,000 per year. At $250,000, 3% would be $7,500 per year. At $500,000, that becomes $15,000 annually. Now the income is starting to look much more meaningful. And at $1 million, 3% would equal $30,000 per year before taxes. But remember, these are mathematical examples. Dividend yields change, companies can reduce dividends, and investments can lose value. Taxes, inflation, fees, and your actual investment returns also matter. That's why you shouldn't build a plan around one perfect number. So how do you actually turn the $25 idea into a system? The first step is almost ridiculously simple. Automate it, set the contribution to happen automatically after you receive your income, so investing doesn't depend on whether you remember. Second, don't confuse dividend investing with buying whichever company advertises the biggest yield. An unusually high yield can sometimes signal that investors expect trouble. A falling stock price can make a dividend yield look artificially attractive. Third, diversification matters. Instead of betting everything on one company, consider spreading your exposure across many investments. Fourth, Reinvest dividends while you're still building. Those tiny payments may feel irrelevant today, but they become additional capital working for your future. Fifth, whenever your income increases, consider increasing your investment too. A raise doesn't have to become entirely a lifestyle upgrade. And sixth, measure progress annually. Watching your portfolio every 5 minutes won't make it grow faster. Now let's talk about mistakes, because dividend investing has plenty of traps for beginners. Mistake number 1, chasing extremely high yields simply because the percentage looks exciting. Mistake number 2, assuming every dividend is safe. Companies can cut, suspend, or completely eliminate dividends. Mistake number 3, constantly switching investments because another stock looks better this month. And mistake number 4, quitting when markets fall. Market crashes can be uncomfortable, but volatility is part of investing. Finally, don't confuse dividend income with total return. A stock paying dividends can still deliver poor results if its price and business deteriorate. Now imagine Finn looking backward after years of following this boring little system. He remembers when the entire plan started with just $25, then came his first dividend. It was tiny, maybe a few dollars, but psychologically, it changed everything because his money had finally paid him. Then came $1,000, $10,000, $50,000, and eventually $100,000 in invested assets. The important thing isn't that every investor will follow exactly the same path. They won't. Returns will differ, income will differ. Markets will change. Some people will invest more, others will invest less. The point is that the process can evolve. Your $25 contribution today doesn't have to determine the size of your portfolio 20 or 30 years from now. $25 won't make you financially independent next month, but $25 repeated hundreds and eventually thousands of times can become something very different. Think about the difference between one investment and hundreds of investments. One dividend may barely buy a coffee, but thousands of dollars invested over many years can potentially generate meaningful income. And when you combine contributions, investment growth, dividend reinvestment, and increasing contributions as your income grows, the picture changes dramatically. Of course, there are no guarantees. A portfolio can fall, dividends can be reduced. Inflation can reduce purchasing power, taxes can reduce what you actually receive, and a 3% yield is only an example. The goal isn't to find a magic dividend stock that makes you rich. The goal is to build a system that you can realistically maintain for years, automate the contribution, diversify, reinvest when appropriate, increase your contributions as your income grows, ignore the temptation to constantly chase whatever investment is trending, and give your money time. Because the biggest advantage you have as a small investor isn't necessarily having more money. It's having the ability to start. The point isn't that everyone will reach $1 million. The point is that starting small doesn't mean staying small. If you're starting with just $25 a week, you're not behind. You're at the beginning, and every journey toward financial freedom starts somewhere.